Yo le paso un papelito para que lo anote y lo vamos a ir pasando a Mark, que es nuestro moderador, para que puedan ir haciendo las preguntas. Listo, pues entonces Mark, te cedo la palabra. Gracias.
Gracias, Daphne. Soy Mark Beam. Bienvenidos a nuestro panel de From Ideas to Action, Analysis of the Impact Investment Sector, Considering its Wide Reach and Varied Approaches. So that's our given title. Let's see how close we actually stay to that, because I think with the two panelists that we have and my strange path, we'll have a fairly interesting conversation. I spent 11 years on Wall Street between 83 and 94, working for really big banks, trading, sales. So I really understand sort of the mainstream investment world, and yet now I live in Oaxaca, Mexico, where I've been for the last 10 years, working with indigenous communities, forming a hub, a co-working space based in Oaxaca. And I'm really excited because today's panel, I think, gives us the opportunity to talk about the venture model, the mainstream investment world, and where impact investing is sort of maybe growing into it, and whether it's the only model that is necessary for us to integrate ourselves into the mainstream. I think those are some of the issues that we can dive into. But first, I just would love for each of you to just give me a few sentences about who you are, Paula and Abigail, and maybe also what led you to impact investing.
Okay, thank you, Mark. My name is Paula Pedrosa. I work for the Multilateral Investment Fund. We're a trust fund in the IDB group, in the Inter-American Development Bank. We operate as a fund of funds and have invested in Latin America and the Caribbean since 1996. And currently we have a portfolio of 54 funds. So we not only invest, but we also provide technical assistance. And so we feel that from those two perspectives, we can share a lot of knowledge from our experience in the past 15 years investing and impact investing. And it's great that you ask that specific question about what leads us to impact investing. We ourselves consider that we have been doing this for longer than the definition is out there. The commitment, as this morning Lisa and Charlie mentioned, has been there. And we were measuring some indicators, but of course, I think that over the years, we have been able to improve that measurement. And of course, using all the taxonomies that are there, we don't want to create any more burden to our clients. We are actively starting to measure, and that makes, as the definition explained this morning, as an impact investor per se. In the past 5 years, we're also, it's not our focus, but part of our portfolio has been going through specific BOP funds or impact investing funds. And we're working also to build the ecosystem around not only investments, but also the whole spectrum.
So my name is Abigail Noble. I work for the World Economic Forum, which is most often associated with the annual meeting in Davos every January. The World Economic Forum has been around for over 4 decades, and it really acts as a convener of people and of insights, and is structured very much like a microcosm of the world. It brings together governments and businesses and civil society and faith-based leaders and academics. And by bringing together the CEOs and the heads of state and the top decision makers across all sectors and industries and geographies, we really try to move forward important issues. And like a pendulum, if you move it a tiny bit at the top, it swings throughout. So over the past few years, we've been looking at what constraints governments face. So they've had, significant budget constraints. the same time that societal needs are increasing. And investors are thinking about, beyond just financial return, how can we make an impact? Impact investing sits at the intersection of all of that. So to Paula's point, impact investing has been around for longer than the definition. And institutions like the Inter-American Development Bank have been doing a lot in the field. It has been more recently that investors, that financial institutions are saying, we need to measure things beyond just financial returns. And we're interested in the link between when you reduce income inequality or create more social inclusion, how might that reduce volatility in markets, or how can we have a better long-run financial return? So I lead the impact investing work at the World Economic Forum, and we're very much looking at how we can bring more mainstream investors into impact investing and really harness the power of private capital to create more resilient societies.
Thank you. So just a little bit more context. If you step back and you look at how things evolved, just maybe my perspective of how things evolved. So you have these major development banks that have been working in this field for a long time in emerging markets and throughout the world. You have governments that have been doing the same thing. You have Wall Street that's usually has emerging market areas of the banks, and they've been looking at it very traditionally as, you know, where can we find maybe slightly higher risk investments, but investments that are going to scale rapidly and provide returns to shareholders. And then you have this nascent, starting in the 80s, the socially responsible investing movement, firms like Calvert Foundation and Calvert Securities, Domini, etc. And then while that was happening, in the background, microfinance was happening, starting to take off thanks to Mohammed Yunus and many others that joined that way of financing the poor. And you had fair trade starting to take off. You had clean energy that even in the early 2000s was still fairly a hippie investment, I call it. And then, but slowly you started to see really serious investors into clean technology, and this started to merge into what some people were calling double bottom line, triple bottom line, social capital markets, lots of names, but eventually it became called what we're calling it today, the impact investment world, which includes social entrepreneurs that are on the ground, looking at their own community's challenges in many cases and trying to invent solutions using the tools of business. And so all of this is coming together, and yet at times I think that we're still thinking about the models that have already existed, like the venture capital model. And so my first question to Paula is, can you just give us a brief description of the venture capital model, what it is? Because you guys have done this study of
in
venture
Spanish,
capital
we call, instead of
in
calling
Latin
it capital de
America,
riesgo, we like to call it capital emprendedor. Thank you. So as I explained before, we invest in funds, and those funds that we try to be aligned in what the purpose of the fund will be, will also invest in companies. We focus mainly on seed and early stage. So our companies that are starting from scratch, or that they haven't really proved their concepts yet. And the fund manager that is getting our money to invest in that company not only provides debt or capital or other types of financing, but also goes through the process of formalizing many aspects of the company in terms of HR, in terms of abiding to environmental standards if the product has to do it, and really they walk through the process with the company until, of course, if they find a good buyer, they sell the company, and these companies then continue to grow. And it is important to highlight that, well, in general, venture capital, in Spanish, we call, instead of calling it capital de riesgo, we like to call it capital emprendedor. And that's because of we're going with these fund managers through the whole process. These managers are, according to the study, persons that have been abroad and are coming back to their countries because they feel that they can add value to more companies. And we have supported about 38 first-time fund managers. That is another thing that, as a development financial institution, we think we have contributed to the ecosystem, because usually what happens is that you have to get to, like, if you are a fund manager and you want to raise a fund with different investors, people will invest in you if you have a proven track record. And in particular in Latin America, when there wasn't that track record, we invested in those fund managers that we thought had the qualifications to do a good job, and we are happy to say that a lot of impact has been created.
So I would maybe add just to sort of, like, and this I think was mentioned in the paper, but basically, and I think Randall in the very first session sort of outlined the cycle. It's business idea, seed capital, business processes, so you really try to refine the model, you take more capital, you give away more of your company, you scale, you try to sell whatever it is you're selling very rapidly, and then usually in the traditional venture capital model, for investors who are seeking high returns, there's an exit. And so you're actually trying to sell out at some point within 3 to 5 years. So according to the study, $1 invested in VC can generate up to $6.45 in economic activity through wages, payments to providers, and taxes, and jobs. I mean, I think that's what we hear, and what is true is that most jobs in whatever country you talk about are started by small businesses. So venture plays a really, really important role. And I want to dive into what some of the results were in terms of the venture capital study in Latin America before we jump into the bigger main stage investment scene.
Okay, so basically we wanted to understand a little bit more what the impact of the portfolio of funds had in the last years, and at two levels. At the systemic level, understanding how the portfolio was contributing to private sector development, that is one of our core missions at the MIF, and also promoting economic growth, and also to understand what each fund, what the impact of the funds were at the company level. So I just want to make a small caveat in terms of methodology. This is like the first study of its kind, because it is data that the MIF provided to the Dalbert Consulting Group, that is the one that did this report. You can go to our website and download the report if you want more information. But of course the methodology is not perfect, because if you really want to understand what happened to a company, for instance, you have to have a counterfactual. So if we call it impact study, it's not 100% a rigorous impact evaluation. And of course, with the methodology, they try to create a comparison to have a company that, for instance, a fund manager has in pipeline 2 different companies, and at the end decides to invest in one. From that company, we have the information. But from the company that was in pipeline and had the same intrinsic characteristics, we don't have that information. So every single finding of the report has to be taken into that consideration, that we're talking about a universe of 28 funds that responded to our survey, and that, of course, there is also some indicators that just started to be collected, and that some of the conclusions are also coming from interviews and field visits. And so please don't extrapolate these results to generalize that this is what happens in Latin America because VC funds invest in companies. I think that I want to share two important results, and as you said, and a little bit of background too, SMEs account for 95% of the companies in the region, and they of course are the main source of employment. So one of the specific findings that the report has is that in a time period of 4 to 5 years, companies doubled their size, not only in revenues, but also in workforce. And annually, they were increasing the full-time employments by 13%. And when we also saw that metric with total female employment and full-time employees, the increase was 18%. So it was interesting to see that, of course, venture capital was also promoting a more inclusive and way of seeing how you hire your employees. Another, and in terms of the big result is really what I mentioned before about the formalization of the company itself, because the fund manager goes through the whole operative process and tries to help the company really conduct business as a bigger company. And so all the formalization in terms of putting in your payroll employees that were before, that also creates a lot of social mobility because you are formalizing the HR process and also your payroll and everything. And as companies grow, they have more salaries, and then you will have a social impact because your employees are moving up the ladder in the social pyramid as well. And I have more other results to share, but let's continue with the discussion.
Yeah, I will definitely draw more out from you as we go on. I wanted to spend that time with the venture model because it's become such a fixation in the investment world, in the mainstream investment world. It gets a lot of press because of the great success stories that have been created, like Google and big companies, especially in tech, but in many sectors. And so it gets a lot of attention. And it has formed a lot of expectations in investors' minds in the mainstream world. So, Abigail, I want to move to you, but maybe we can show this video first. I think it's a really interesting, short, 4-minute video that kind of will take us to the next sort of segment of the conversation.
Exclusively really help free social investors, but their mission inward investment
As we've seen through the economic and financial crisis, money without values can maybe not create the world that we want.
We explored impact investing, which at the time sat in the social entrepreneur space. We actually found there were lots of parallels with strategies that mainstream investors pursue, like value investing.
It's really about finding a way to harness the power, the speed, the flexibility of the capital markets and the private sector in ways that are very much in concert with the public sector and the community's goals. And I do think that, frankly, at the end of the day, that's going to get repaid in spades.
The people who are crowding around this now and putting money to work are the pioneers who found a reason to attach capital to it, to start testing and putting it to work. As they begin to have success, it'll bring in that next wave, and I fully expect that the skeptics that are here today at some point will sort of be part of the wave that best matches to their own risk aversion, and eventually we'll have the market that we want.
We've seen impact investing become more and more popular over the past few years because investors want not only to create profits and financial returns, but also to do well in the world.
We're really excited about the growing emphasis on impact investing. We've been in this space for about a dozen years, have invested $3 billion.
Impact investing suffered for a long time from a plethora of definitions and a plethora of players. Each brought their own definition to the table, and that held the sector back for a long time.
And therefore, certain skepticism still in what it really means from an investor and how it can be integrated in a portfolio.
Impact investing is an intentional strategy to create both financial and social returns that's actively measured.
If you're going to attract mainstream capital, really clarifying that impact doesn't necessarily mean lower return. They have really the ability to execute a variety of strategies that conform to their existing kind of allocation needs, but also produce impact.
We believe that the interests of the young generation will influence the actions of institutional investors dramatically in times to come, and impact investing will be part of that portfolio.
Over the next 4 decades, the baby boomer generation is going to transfer $41 trillion of assets to the millennial generation. I think investors are going to have to think a lot more about businesses that do create societal, environmental, and economic impact.
The more that we start thinking about some ecological balance and some social justice issues with some parts of our funds, I think we can live in a less volatile, more sustainable world.
My hope is that over time, they will become something that is not the domain of the inspired philanthropist or the inspired capitalist who wants to try to mix the two disciplines, but that it's just a part of how we run businesses. In the future, risk managers, financial analysts, equity analysts, investors themselves assume that, of course, we're going to be taking much more holistic views and analyses of environmental and social considerations.
We'll start to see more capital be allocated to this and done so in a way that's prudent from a risk standpoint.
Impact investing might not be a silver bullet, but it is a bellwether for what a lot of the millennial generation thinks is wrong with society or wrong with financial markets.
Which is enormous, and any survey of millennials will tell you anywhere in the world that the number one reason, the number one characteristic that identifies themselves as different from other generations is the desire to make a positive impact, which is huge. We also know that things can happen really fast these days. The infrastructure that's in place, the media channels, the Kiva came up like that. Google, like Facebook wasn't even, it's not even 10 years old. So we know things can happen rapidly. So I feel like it's really important to get it right when it's in these stages. One of the things in the venture capital study that you all did, Paula, said that that the VC model really reduces the gender gap, and I'm really curious to hear how and how you back that up.
Well, I think that I mentioned it before when I was going through the increase in full-time employment. But in general, was to go to analyze those specific funds going to the companies, and the companies itself having a more professional and objective way of hiring people. And so what the study found was that the female workforce increased even more than the general workforce. And so that's why the report claims that reduces the gender gap. It was basically through that specific finding.
So do you think this is the where I kind of want to open it up to both of you? What is the biggest challenge in bridging a world where you are, on the one hand, using an investment to focus on bridging the gender gap, or by embedding environmental practices, et cetera, and the financial return side? Like, how are we going to get this right so that we don't just replicate the venture model as we know it, and it becomes co-opted from what we're all trying to do here?
At least in Latin America, we feel that we're not following the Silicon Valley venture capital model, because it's not that in one fund you will have one home run and that will like create a Facebook or a Google, or in Latin America it's different. Like in a fund you can have 2 or 3 home runs that will indeed have that impact that you want. But you have to keep that idea, at least in our region, as we're here in Mexico, that you cannot generalize or just like think that the path to follow is what happened at Silicon Valley. And in terms of expectations of returns, I think that what we have seen in the reports also shows a little bit of that, is that without the financial return, you can't really have good stories on the social and on the environmental, because it is just impossible. So you have to keep that in mind, that you have to build the enterprise, and if that enterprise is serving the base of the pyramid, even better. But you have to get first the numbers right, and then you will be able to tell a more cohesive story about the other impact too.
I'm glad you said what you said, because I've been saying it a lot lately, that I do think that Mexico in particular, and Latin America in general, has the potential to reinvent or really innovate on the existing venture models, but all the models that are arising within impact investing. Abigail, do you have any comment on?
So just maybe saying something that might be slightly controversial here, in that, venture capital is a probability game. And when you're dealing with social impact, or when you're dealing with really important needs, you need to be really careful. At the same time, when you're building a new space, you need to experiment and innovate and be willing to fail, and fail fast. So it's an important tension that we need to figure out and just be mindful of. And there's no answer to it, but we just need to figure that out, or just be cognizant of the risks that, in a venture world and in a very early nascent sector, there are going to be some unfortunate casualties. And, I worry sometimes about, what happened with microfinance, where it grew very fast and it became this kind of miracle opportunity to get both, bottom lines. And then when, there was a news reports and of people not spending the money as well, or suicides, it just collapsed people's interest and passion in the good of microfinance. And I just want to be very careful that we don't end up in that kind of a situation with impact investing.
Even though we do need failures to grow and develop.
What's that?
Even though we do need failures.
We absolutely need failures, yeah. So
grow.
we just need to figure out the right holding environment for that. And I don't know if you've been thinking about this, Paula, or it keeps you up at night as well.
Yeah, the problem with, and particularly taking the microfinance example, is that the expectations were so high. And when something starts working, then everyone thinks that is the panacea and the silver bullet, and that's the way to go. And sometimes we have failures too. And in our case, we've had many, many bad stories that we also like to share, because that's what really happens. So I think that we still have a couple of years before, through measurement, we can get some results. But until then, I think that we should all advocate to keep like expectations, like not low but reasonable, and not too, because impact investing is also a buzz. It's a buzzword. It's very trendy right now, but we have to be careful not to really go beyond what can really solve this sector.
One of the things I read, I think in the World Economic Forum report, was a quote that said, "There seems to be powerful but latent demand among retail investors for impact investments, but many investors are waiting for their clients to ask for it. My guess is if you build it, they will come." I watched what happens in these retail, like Merrill Lynch or Lehman, used to be Lehman, JP Morgan, the ones that really focused on the retail consumers, client investors, the brokers, and by the way, the lone wolf of Wall Street is a complete farce, by the way. So exaggerated, but basically true, but exaggerated enormously. When you start at a mall, a Wall Street firm that was born in a mall, and you hire drug dealers to be your first salesman, it's just not Wall Street, okay? So
that's what we should do with impact investing. Kidding.
But I know at the same time what those retail salespeople are, they want a story. That's how they sell. They sell by telling stories, and I wonder who's gonna help them tell their story, or how that happens.
That's actually something we've been thinking about a little bit, because we've heard from some of the banks and wealth management practices that their wealth management advisors don't have the awareness of what is impact investing, what are the range of products and tools. So we're looking at how we can help them prepare, whether it's training courses and education, whether it's thinking through the performance incentive systems that a lot of these financial institutions have, because right now a lot of these advisors are measured based on financial returns. But what if, and right now we're seeing a lot of high net worth individuals wanting to get more involved in impact investing or have access to those products. If they ask their wealth management advisor, and if the wealth management advisor then is incentivized on the satisfaction of their client and of adherence to their goals, whether it's a certain kind of social impact or legacy and capital preservation, we can start to move a little bit more in that direction. And we are hearing from some of the large banks like the UBSs and the Deutsche Banks and Morgan Stanley that they are working on this internally. So I think it's a matter of time.
A matter of time, and also being able to show some results, because it's like el huevo y la gallina type of problem here. Like who are the first that are really jumping into this, but they want to see results, and so a lot of the players are just like waiting to see what happens. So
I think we should probably try to share the link to these two reports in some way. I think they're really valuable documents to read. One of it also, both of them have recommendations, and one of them resonates with me because I'm an advisor to Halloran Philanthropies, and we have made a point to try to be early in places like the fund development. For example, Adobe Capital starting their fund here. And the model for a fund, you have to basically raise at least $15 million to pay the management fees that allow you to actually cover the cost of operating these funds. And I would recommend to those other investors and foundations in the room to think about supporting the infrastructure behind these funds, because it's a real struggle to tell the story of impact investing at the same time as you are trying to survive day to day. So I want to open it up to questions, and how do you want to do this? You want to have people write down questions, or can they stand up, and is there a microphone?
I can share my microphone.
Certainly there must be some provocative questions here.
Hi, Leticia Jauregui from CREA, and I work with women entrepreneurs. I think I had two questions. I really liked your comment about the failures, but I think one of the things that's lacking is the postmortems. It's not just looking at failures and seeing a lot of big failures in media, but actually dissecting and understanding what happened. So I'd love to hear if you've seen any of that put forth. And then in terms of the gender gap, it's very true that more women gain social mobility through that, but it's also true that women employ more women. So what's going on with the women's growth within those businesses? What percentage of women are actually getting that investment and being able to grow the businesses themselves and also accessing that labor market?
I'm glad that you asked about that. We recently started an initiative that is called We Exchange. And we had a conference last December, I guess. I'm sorry if I'm missing some details here because I was out of the office. So I'm happy to put you in contact with the right person at the MIF. And so the idea was to really see not only more women raising funds, but also like funds really going into companies that are run by female CEOs. So basically what we did in the conference was to also have a space for these entrepreneurs to show what their companies were and also to do like the pitches and see if they get financing and if they get good results. But yeah, it's true that we're trying also as a development financial institution, not imposing quotas, but promoting this new dialogue because it's something that it was needed.
So very good question about sharing the learnings and the failures. There are a few things that I think are great opportunities to learn about some of this. So Impact Assets, Pacific Community Ventures, and the Duke Case I3 Center came out with a report in November called Impact Investing 2.0, which looked at all of the top performing funds and what they did well and what they learned. So there are some really good insights there. The World Economic Forum, along with the UK Cabinet Office and the Impact Investing Policy Collaborative, have created a platform called the Global Learning Exchange. So we launched it back in November, and over the coming months we have monthly webinars. The next one's actually tomorrow morning. And then in-person convenings a few times a year. So we have one in Panama in the beginning of April and one in the Philippines in, I think, April or May actually, where we're trying to bring together people who have been thinking a lot about social innovation and impact investing and sharing some of these failures in an off-the-record, confidential place where we can collectively brainstorm forward. I do worry about sharing the failures without context because it could be an opportunity for someone to say, hey, this doesn't work. So I think we need to figure out the right balance between saying this particular thing didn't work in this context and this is why and this is how we can innovate for the future. But a list of failures or too much self-doubt could hold the sector back in a way that's crippling rather than constructively growing forward. Yeah, so just keeping that in mind. But transparency and learning from what didn't work is really important.
Just to add something real quick, we are known as a repository for lessons learned, and the MIF also did another publication a couple of years ago about the lessons learned of 13 years at that point of investing in the region. And I wanted to, well, beyond the one that you mentioned of the fund size matters, I think that we have to keep in mind that impact investing is something that will take longer than usual to show results and to be patient. It's like patient capital. not only in the investments itself, but also as institutions and as development financial institutions, as foundations or private sector institutions that are entering into this space to really like make sure that they understand that they will have to go through different crises and not to just like go away and that is a lesson that we as a fund, as the MIF also had. Like after the burst of the .com bubble, we were in the region and we never left. And now we are seeing that we are recogiendo those frutos from that patience. So I think that's a message that we also have to keep saying, so people keep that in mind. And we see that in our investments now. Like we have seen in our portfolio, or the portfolio companies of our investments, that things can just like move from one month to the other to good, bad, maybe home run, maybe write off. And so we're just waiting to see what the results are.
I think that's a really important point. I think the expectations of the timing expectations, everything around us is telling us to go faster. Like the media, the investment field itself wants immediate expectations, and by nature of the people that we're working with in communities around the world, things just take longer, and we should allow for that and enjoy it. It's life, you know?
Yeah, because I think that you will do more harm if you go to a region and then at the first moment that crisis happening, you go.
Any other questions?
Yeah, I'm Raul from Unreasonable Mexico. We support entrepreneurs solving big challenges. So I love the huevo gallina example. I think it was like a great description. And my question was like, what must happen to accelerate progress? I mean, at the end of the day, how many people are less poor than yesterday? And very important, how are we communicating those results?
Well,
I mean, it's a complicated question, no, but I would love your insight.
Well, I think that the most important thing is to have sustainable interventions, to see that that what you're doing, or that the companies that are also working with the different communities or the different type of impact investment interventions, that they are doing really solutions that will last over time. Because you also see a lot of like philanthropy money going here and there, but those, you have to really articulate at the grassroots level to have that change that you are talking about. And how to accelerate it? Well, that's a very good question.
I'm glad I'm the moderator.
Well, so poverty is a really complex issue, and it has many mothers. And it's really hard to tie it back to something like impact investing or a particular development innovation. But I think what we can look at sometimes is, how average incomes might improve in a certain sector that something like the Inter-American Development Bank might be investing in, or a certain product that comes to market, whether it's like clean cook stoves or lanterns or low-cost tablets for reading or something like that, and how that links to, literacy rates or school attendance rates, or, children's asthma, and, how much money families spend on energy. And I think we need to do a lot more rigorous collection on those specific indicators, and then come up with a more comprehensive understanding of how poverty is changing. And there's one social entrepreneur, do you guys know who Martin Bird is, of Fundación Paraguaya? Yeah. Came up with this traffic light of indicators of moving out of poverty. And it's brilliant because it shows that, GDP per capita is meaningful in some contexts, but when you're talking about poverty, not as much. You want to know whether people now have indoor plumbing or not, whether they're able to go to the doctor whenever they need to, or able to send all of their children to school and pay the school fees. And those kinds of indicators tell us whether we're making progress or not. And you need to evaluate that regularly over time to see how communities are moving out of poverty. So I'd like to see a lot more those kinds of indicators and that kind of metrics and analysis. And if we can tie that back to things that, impact investing or social enterprises, a lot of them, unreasonable institute fellows are doing would be fantastic.
I think that standardized measurement is the key word at this moment. Like, if you really want to really understand where you will have more impact, you have to have some data, and over time you will be able to see in which sector or with, I don't know, which business model you are really having more accelerated impact, as you said. But we still need to see some results, as I said before.
I think there's some models arising that are really working, and they're still probably invisible. There's a couple people in this room that I know that are breaking ground. There's another example called Innovando la Tradición, which is the nonprofit side of a hybrid organization. The for-profit is called Colectivo 1050. And the Innovando la Tradición is exactly what it says. It's innovating on the traditions of people in Odzompa, which is at the foothills of Monte Alban, and they've been doing artisanal pottery for 2,000 years. But she's at their pace, co-creating like new designs, but using the same traditions, improving the ovens so that they're not using wood anymore; they're using biomass. But at the same time, she's got the for-profit that is taking some of those designs and creating a retail distribution chain for it, so that there is that profit side that's working as well. So, and I think probably Alex, who has a question, could probably offer some advice as well.
No advice this time, but I get to ask this question every year, and so I'm going to reframe it and ask it again because this is a really interesting context. One of them, it's a really good, I think, add-on to the last question, is that really poverty is an extremely complex issue, and really the data basically shows that microfinance, for all its benefits, hasn't really made anybody less poor. Just like loans to a middle-class person doesn't generally make anybody less poor. It makes their life better, which is a really great and important thing. I mean, you're not less poor if you have a roof that doesn't leak, but your life is certainly a lot better, right? So I think that we continually tell ourselves a lot of this idea of raising people up out of poverty, I think, is maybe a false expectation that we saddle with a lot of these sectors, and sometimes we're trying to make the world better, not necessarily have people have more money. We tell ourselves a lot of falsehoods here in the impact sector too, and there was a couple in the video that are like my favorite, which is, listen, impact investing is incredible because there was the one gentleman was saying, I'm just going to take the same returns that I have in all the dirty investments we make, and then I'm just going to save the world and make the same amount of money, and that's just a great thing. I mean, who wouldn't want to do that? And it's the same thing as an entrepreneur. I'm always forced with saying, listen, I'm an impact investor, so I want the same amount of money as a return, but I also want you to give me like tons of reports and demonstrate that you've made everybody's lives better. So if that were really the case, if I just was going to give you the same return, then why wouldn't I just go to someone else who would just give me money? I wouldn't have to give them reports and show my impact. And so my question to you guys is, we often sell the impact investment. It's a vision that's amazing, and I'd love to see it come to fruition, which is that governments would play less of a role potentially, and that capital would truly have a conscience and could start making real impacts in these issues. And it's maybe you're not donating, you're investing, you're getting your money back plus, but maybe it's 10% and not 20. Maybe instead of these deals where I need to repay my investment times 2.2, I repay it times 1.2 or something, you know, like. Now, is there anybody in impact investing, is there anyone that's saying, I'm willing for social returns to value them equally as money returns and ask for less of a return on my investment? Is that a movement? Because when we're talking about somebody going forward, is that something that anybody's really ready to step up with capital and say, we're going to make less money, but we're going to have that impact, and then if impact is part of this double bottom line, then those two should sum to the same return that they used to have. That is the rephrased version of the same question I ask every year.
Microphones come my way. Yes. I don't know if you saw Lisa and Charlie's presentations today where they talked about the returns across asset classes and a very realistic perspective. You find it's more common among high net worth individuals that they say, this is what I want to do with my money, this is what I believe in, and that comes first. And as long as I don't lose my money or lose too much of it. And then you find some investors that say, we're in this for the longer term and we're building a sector, or we're going into a market where we might make a pretty low return or our money might be locked up for a long period of time, but we're going to learn, and eventually, you know, we believe in renewable energy, or we believe in very low cost access to Wi-Fi, and then we're going to have, you know, first mover advantage in this region on Wi-Fi access. And Wi-Fi access would, you know, then give greater access to education and mobile health and things like that. So you'll find some investors that take that perspective. I think we also just need to put it in context of, you know, investors have responsibilities. They have fiduciary responsibilities, and that's for good reason. So private equity funds are trying to make, you know, 15 to 25% return because they're managing money on behalf of pension funds, and pension funds have this fiduciary responsibility because they want to make sure that they can provide payouts to the 70-year-old, you know, grandmother who is also taking care of her, you know, children and her grandchildren, and you know, needs to pay the heat, and heat bills are rising. So if you trace it back, there's a reason why there is this pressure about financial returns. Some of it is greed. It happens. I mean, we're human. But some of it is greed. But some of it is the way that we've set up society, and we need to be sometimes more comfortable, and this might happen in the future, with a lower growth environment, with less progress, with less luxury goods and constant appetite for what's new and what's next. But I think we also need to understand the context in which financial returns and healthy financial returns can also help businesses grow, or investors continue to, you know, stay liquid and deploy more capital. And maybe transparency or greater transparency in this area will help us figure out the right line between that. Maybe we do have some lone wolves that kind of distort the market, you know, and paint it poorly for everyone else. But the bottom line is that there are a range of returns across sectors and across geographies. There are a range of impacts, and each investor needs to think about what they want to get out of it, who their responsibility is to, if it's just to their, if they're a high net worth individual and it's just to their family, if it's, you know, a wealth manager, and or, you know, if it's an insurance company that's thinking about how it's going to be able to cover risks in the future, a pension fund that's thinking about its pensioners, but really tracing back what the money is for, and why we need to be responsible for it, and what kind of future, what kind of mandate we have with it, mandate, time horizon, all of that. So I don't have a complete answer to your question, but I do think it is something that we need to tease out the complexity of more.
Well, even though I'm a moderator, I'm going to add to this. One, the B Corp structure, or embedding the return assumptions that are balanced into the legal structure, is huge, because that's not the mainstream market right now. The other thing is that the majority of investment assets around the world are in fixed income assets. They're the most liquid, largest markets in the world. And the return expectations there are anywhere from 1 to 8% right now. So 8 would be huge for a 30-year bond right now. So there's so much room for innovation around other type of investment vehicles. That's why I think the venture model gets a little bit too much attention in this room, and in this because it's important to bring these subjects up, but in the investment impact space, there's so much money out there. And now we also have tools like crowdfunding, where individuals can directly invest. And we've already, and the microfinance model has proven that you can lend money, and it's less risky than lending it to people that have 2 BMWs in their lot. So anyway, I think there's a lot of room for innovation for us to think about. And unless you guys have anything else, we're gonna. say goodbye. Thanks.
Muchas gracias a nuestros panelistas. Lo que sigue ahora es la comida, va a ser en el tercer piso.